silver has bottomed here at $66. We're not going to see anything lower than that. And now we're back above 90. I don't think we're going to go below this bottom. I don't even think we're going to go below 70. I think the correction is done. Why I'm calling the bottom in the silver price. This is silver open interest. It says here 134,620, but this is on a one-day delay. The actual CME numbers are now 126,789. There was a huge drop from yesterday, and I'll show you exactly why that is. It's about 8,000 contracts, a little bit less than 8,000 contracts fell off. So this is the COMEX tables, the CME tables of what happened in silver trade yesterday on the futures. So you can see March silver over here. This is the active contract. It is rolling off and it's becoming spot in the next 2 trading days. So because today's the 25th, so we have the 25th and the 26th, and the 26th would be the last trading day. Why didn't they roll them over? Well, if they're a bullion bank, they can't do it profitably because the price of London spot silver is still higher than New York futures, and it's been that way on and off since October 9th. You know what happens after silver backwardation? Gold backwardation, which means the end of the dollar. This week's silver report, we're going to go into why it is very likely that silver has bottomed here at $66. We're not going to see anything lower than that. We're seeing it in the backwardation. We're seeing it in the open interest. We're seeing it in the reaction to the tariff smackdown by the Supreme Court. Silver should have gone down, but it didn't. And we're seeing it in the lack of rollovers from the active contract to the next active contract because of the backwardation, which prevents bullion banks from going short silver in New York and going long in London because that is not profitable. And so they run out of the New York futures, and that enables price to move even higher. This correction was very short-lived. It appears to be over. We're going to go into exactly why, and that it's been 5 years since the Fed's favorite inflation indicator, the core PCE, Personal Consumption Expenditures Index, has been below 2%. It's been 5 years.
5 years?
They've been over target for 5 years. Remember symmetrical symmetrical inflation. I sound like Chinese. Symmetrical inflation, that rationalization or justification for the personal consumption expenditures core measure to be over 3% or over 2% for a symmetrical amount of time so that it compensates for when it was under. Well, I wonder if we have to be below 3% or below 2%, whatever the target is, symmetrically in order to even out the inflation indicators. Of course, that's not going to happen because the Fed has already lost control. They can't get their inflation indicator down to where they want it to be. It's over already. It's just watching the dollar die now from the sidelines with your gold and silver.
When inflation stays above 2% for 5 straight years, temporary stops being credible. As Rafi Farber argues, backwardation and falling rollovers hint at tight physical supply, but investors should separate structural signals from narrative conviction. Core PCE hasn't sustainably broken 2% since early 2021, yet rate policy since 2022 has already tightened financial conditions sharply. The real question isn't whether silver bottomed at $66, it's whether liquidity cycles and Fed credibility are diverging again. If monetary policy credibility erodes further, metals respond before equities do. Next, Rafi Farber connects this to long-term commodity stability trends.
Anyway, let's move to the slides already. We're running out of time.
I'm running out of time.
Thanks.
This is the first chart I wanted to show. It's kind of lopsided. I made like diagonal rectangles here, which isn't exactly legitimate because it doesn't track a static time period. You need vertical lines for that, but whatever, who cares? Anyway, from somewhere around 1990 to 2008, you can see monetary stability here. This is the gold CRB ratio. How many ounces or how many baskets of CRB index, which is the commodities index, can 1 ounce get you? 1 ounce of gold. So this is the higher this is, the more valuable gold is relative to all other commodities. So here we see from 1990, it goes before 1990, from about, let's say 1985 or so. 1990 to 2008, we had pretty good monetary stability. Gold's value was stable relative to a basket of other commodities. And then from 2008 until about 2020, you see that things have started to get a lot more wobbly over here, right? And slowly the other commodities were degenerating in favor of gold, which means that gold was getting more expensive and other commodities are getting cheaper in real money terms. This is when credit gets less and less valuable and money becomes more and more valuable because they're printing credit too much. And this is what happens. And then you see extreme monetary stability over here from about 2020 to now. This is not normal. It should never be this way when credit is even relatively stable, which it is not at all. You can see the monetary instability is getting worse and worse, and it's going to just fly completely out of control in the end game. We're almost there.
When gold outperforms an entire commodity basket for over a decade, that's not stability, it's a warning. As Rafi Farber highlights, the gold to CRB relationship shifted notably after 2008, the year of systemic credit intervention and QE expansion. Since 2020, balance sheets across major central banks exploded again, distorting price discovery across energy, food, and metals. If gold's relative strength persists while global growth slows, that reflects monetary distrust, not commodity weakness. Long-term investors should watch credit spreads and real yields alongside this ratio. And what Rafi Farber implies next raises bigger questions about futures positioning.
One of the reasons why I'm calling the bottom in the silver price, this is silver open interest. It says here 134,620, but this is on a one-day delay. The actual CME numbers are now 126,789. There was a huge drop from yesterday, and I'll show you exactly why that is. It's about 8,000 contracts, a little bit less than 8,000 contracts fell off yesterday. That is February 24th, because today's the 25th. So you can see here that at the last time we were at this open interest number, we were slightly above it here. So this is the last time in late 2023. This was the price of silver back then. It was about 22 maybe, or $23 maybe, something like that. We haven't been anywhere near there since. It hasn't ever gone below that since this number in open interest was hit. And we can see here that we almost hit the open interest here. We were slightly above it at that point. But even in this neighborhood, it only hit that price again. Silver only hit that price again one time, below 30 in April of last year. And ever since then, it's been flying off the hinges. And it looks like we've bottomed over here at about 66 or 65, whatever that candle was. And now we're back above 90. I don't think we're going to go below this bottom. I don't even think we're going to go below 70. I think the correction is done. Here's another reason why. So the 126,789 contracts I showed you in this chart over here, where this little black line is, and I drew it in over here so you could see it.
Open interest drops don't automatically confirm a price floor. As Rafi Farber notes, nearly 8,000 contracts vanished in one session. That's significant positioning change, but it can reflect liquidation as much as conviction. In late 2023, similar open interest levels coincided with much lower prices, reminding investors that leverage conditions evolve. When price rises while open interest falls, it often signals short covering rather than fresh institutional buying. For portfolio strategy, the distinction matters because sustainable rallies require new capital. Next, Rafi Farber breaks down the contract rollover dynamics shaping that liquidity.
So this is the COMEX tables, the CME tables of what happened in silver trade yesterday on the futures. So you can see March silver over here. This is the active contract. It is rolling off and it's becoming spot in the next 2 trading days. So because today's the 25th, so we have the 25th and 26th, and the 26th would be the last trading day of this contract as a futures contract. So you've got to roll out of it. You've got to roll to the next contract in order to keep your futures position. Otherwise, you risk delivery. So what is happening here is that 14,196 contracts closed out, meaning those shorts were bought back. Those contracts no longer exist. And usually you'd see a similar amount or even a higher amount rolling into the next active contract to maintain the futures position. But here we had 14,196 closed out and only 5,350 new ones opened. So a lot of positioners, whether they are bullion banks or whoever they are, that had these contracts long, they closed them out. And they didn't roll them over. Why didn't they roll them over? Well, if they're a bullion bank, they can't do it profitably because the price of London spot silver is still higher than New York futures, and it's been that way on and off since October 9th of last year. Bullion banks cannot provide liquidity in this market because they cannot profitably hedge. It's been that way for almost 3 months, Or is it 4 months? October, November, December, January, February. 4 months. Over 4 months, it's been that way. This is silver backwardation looking like it wants to become permanent.
When 14,196 contracts close and only 5,350 reopen, that's not routine rollover. That's retreat. As Rafi Farber explains, this suggests traders are choosing not to extend exposure into the next delivery month, and that shift matters more than headlines about price spikes. Backwardation persisting since October implies tight nearby supply or distrust in forward pricing, both of which distort traditional hedging models. For investors, the key question is whether this is structural stress or temporary positioning into expiry. Futures liquidity drying up can amplify volatility quickly, and what Rafi Farber links next raises implications for the dollar itself.
You know what happens after silver backwardation? Gold backwardation, which means the end of the dollar. That's what it means. SLV is being used for quick trades. I just want to show you what's happening here, what has been happening since the silver crash of 2026, of January 29th, 2026, what happened in SLV. So you saw here, here's the crash of the silver price moving from about $110, $120 to about 70 in a day, whatever it was. It was a huge 120 to 70. Wow, that's like $50, $50 in a day or two. Oh my gosh, that is nuts. So we were all waiting for silver to hit $50 for like since 46 years, and then all of a sudden it didn't. It fell $50, and it's still at like 90 now. Okay, whatever. But you see here, the total metal in the trust went way up on January 29th. I think this is the third biggest influx of silver behind one other day in 20 something and silver squeeze in 2021. But this is a huge day of about 35 million ounces of silver flooded in on that crash, and that was bottom pickers, right? They were buying SLV because they wanted to. They saw that the fund would probably jump up as the huge crash would be corrected somewhat. And you can see here, since they did that, since they bought silver on that day, and then silver had to be flooded into the fund because of all those bottom pickers.
A $50 collapse in days followed by a 35 million ounce ETF inflow isn't panic, it's opportunistic capital. As Rafi Farber highlights, that January 29th spike into SLV mirrors 2021's silver squeeze behavior, where retail flows temporarily distorted inventory metrics. But ETF inflows during crashes often reflect short-term traders, not long-term physical accumulation. When metal floods into a trust on volatility, it can signal liquidity arbitrage rather than structural shortage. For disciplined investors, separating speculative ETF flows from genuine supply stress is critical. And next, Rafi Farber reveals whether that demand actually stuck.
But then you see since then, silver has been drawing out of the fund as these traders have sold their shares for that quick bounce, and it looks like they might have gotten a few bucks on that, and good for them. But there's no sustained interest in SLV here. It's just the retail crowd is still dead. There's no interest in this ETF, it looks like. That was just bottom picking. The Fed's favorite inflation measure has been above 2% for 5 years straight now. I highlighted the last time when the 2% mark was last underneath the 2% mark. That was February 2021 at 1.709%. This is the core PCE, the most manipulated of manipulated inflation measures of consumer prices. We are still above 2%. I think we're at 2.8 or 2.9 or something like that. And we had a little bit of a jerk up here, a move up here. So
the quiet detail here isn't the bounce. It's the money leaving right after. As Rafi Farber points out, SLV saw traders grab a quick move, but there's no sustained inflow to confirm conviction. Core PCE hasn't been below 2% since February 2021, when it printed 1.79%, and today it's hovering closer to 2.8 to 2.9%. That's 5 straight years above the Fed's target. That matters because persistent inflation erodes real returns, even if ETF interest looks dormant. Retail apathy doesn't mean inflation pressure is gone. It often means investors are tired before the cycle turns. And as Rafi Farber implies, the real question is what happens if inflation refuses to cool while participation stays this thin.
Looks like these statistics are accelerating again. It's been 5 years, okay? We haven't been above 2% for 5 years at all since, ooh, wow, since like from 1960 something to 1991, something 92, 93. Wow, we were above 2%. So you can see, that opens up another topic of concern that this inflation indicator was above 2% for like, what is it, like 25 years? For a quarter of a century, it was above 2%. Was the Fed doing their job then? No, because they never do their job. They can't do their job is to print money. They do that very well. That's their actual job. Their job is to inflate, not to stop inflation. Their job is to inflate. And that's what they do. So they're accomplishing their mandate of inflation. That's all they do.
That's what he does! That's all he does!
There's nothing else that they could do. Traders sell, stackers accumulate. This is the reaction to the Trump tariff slapped down by the Supreme Court. We would expect that if tariffs are slapped down, that gold and silver would go down because tariffs being slapped down would strengthen trade and strengthen the dollar. And that's what happened in the immediate aftermath of the tariffs being slapped down. You can see that it was about 10 o'clock a.m. It was around here that the ruling came out. And then all of a sudden there was a huge sell-off in gold, or yeah, what is it? Why does it say 95.95?
Inflation above target isn't an exception. It's the norm. Rafi Farber highlights that core PCE stayed above 2% for roughly 25 years, from the 1960s into the early 1990s, and now we're again 5 years into an above target stretch. That challenges the narrative that the Fed's 2% goal is sacred. Historically, it's been flexible at best. When tariffs were struck down, gold and silver initially sold off. Textbook dollar strength reaction. Yet that move faded quickly. Policy headlines can move prices intraday, but structural inflation trends reshape portfolios over years. As Rafi Farber would argue, the bigger risk isn't the tariff ruling. It's a system structurally biased toward inflation.
There was a huge smackdown in gold prices down here, and then it just kept going higher and higher and higher. I think these are silver prices actually, but gold had the same price reaction, right? It went down initially, and then the stackers came, or whoever it was, and started accumulating gold on the sell-off. So if gold cannot be slapped down, or silver cannot be slapped down on tariffs being slapped down, there's something serious and monetary going on here. We'll go to the next slide here, which probably should have been 2 slides before, but you can see here the silver backwardation persists. It's now at $1.64, meaning silver in London is more expensive than silver, future silver in New York, meaning physical silver now is more expensive than future silver in New York. So some people call this backwardation. I will call it that for convenience sake, even though I think that backwardation is really forward curve inversion, but that's, that's an academic point, doesn't really matter. But we see here that the silver has been in backwardation on and off, mostly on, since October 9th when it first hit 50. And every time there is a sell-off in silver, the backwardation reasserts itself. So it looks like this backwardation is becoming permanent. And what happens after permanent silver backwardation is permanent gold backwardation, which means that nobody wants any dollars for any amount of gold anymore, and the dollar cannot buy anything at all. Once silver backwardation becomes permanent, gold is next.
When price drops fail to stick, markets are signaling something deeper than headlines. Rafi Farber notes that silver backwardation, with London spot trading about a 164 above New York futures, has persisted on and off since October 9th. In plain terms, buyers are willing to pay more for immediate physical delivery than for future contracts, which historically reflects tight supply or distrust in forward pricing. Each sell-off reasserting backwardation suggests strong hands accumulating weakness. For investors, that's less about apocalypse and more about watching liquidity stress and physical demand trends closely. As Rafi Farber hints, if backwardation spreads from silver to gold consistently, currency confidence becomes the real variable to monitor.
Next.
Chicken necks.
Now a little bit into Bitcoin, what is happening here in the Bitcoin to silver ratio. Look at this is interesting. The Bitcoin to silver ratio is at a huge pivot point. how many ounces of silver it costs to get 1 Bitcoin. Right now, it's about 714 ounces. This is the 2023 low in the crypto winter, the 2022-2023 low of the crypto winter when everything was crashing. It is also the high of 2019. This is a huge pivot point in Bitcoin to silver. Bitcoin is dead. It's dying. It still has got some life in it yet, but it's not going to recover from here. I'm sorry, guys. It's just this nightmare is over already. You're at the point where you're falling and you're about to wake up. You know, that point in the dream when you're going to wake up and you're falling, and then you realize that it's all been a nightmare. Well, that's what Bitcoin is. It's a nightmare, and the nightmare is only going to show itself when everything that has been relying on the dollar price of Bitcoin falls and dies a horrible, painful death. And here, this is an article from Bloomberg entitled "Bitcoin's $1 trillion Identity Crisis Hits from Every Direction." This is like a panic tone here for Bitcoin in Bloomberg, and you know, take from it what you will. But the point of this is in the final paragraph here that I cut and paste reads as follows:
Ratios often tell a calmer story than emotional declarations. Rafi Farber draws attention to the Bitcoin to silver ratio sitting near 714 ounces, levels seen during the 2022 to 2023 crypto winter and near 2019 highs. That makes it a technical pivot, not automatically a death sentence. Bloomberg framing it as a $1 trillion identity crisis adds drama, but price cycles of 40 to 70% drawdowns have historically been common in crypto. For diversified investors, the key isn't panic, it's position sizing and understanding volatility tolerance. As Rafi Farber would frame it, the next move in this ratio may say more about liquidity conditions than about ideology.
It wouldn't have seemed possible a year ago, but Bitcoin has gotten caught in one of its deepest struggles yet, with no obvious way out. The world's largest cryptocurrency has plunged more than 40% from its peak, and the usual playbook isn't working. Dip buyers have vanished, and the forces that would normally fuel a rebound are now working against it. Gold is winning the macro hedge argument. Stablecoins are winning payments. Prediction markets are winning speculation. The strange part, none of this is happening because the system failed Bitcoin. Washington has never been more accommodating. Institutional adoption has never been deeper. Wall Street has never been more bought in. Bitcoin got everything it wanted, and it wasn't enough. That means the defining struggle of this crypto era isn't about price. It's about purpose. And this sell-off is forcing a question Bitcoin hasn't needed to answer when prices were rising. If it isn't the best hedge, the best payment rail, or the best speculation, what exactly is it for? I have a better question than that. What exactly is it at all?
Nothing! Absolutely nothing! Stupid! You're so stupid!
It's not a thing. It doesn't exist, and soon everyone will realize that it never did.
But existing is basically all I do.
People will tell me, Rafi, you hate Bitcoin more than you love gold. Could be. I can't stand fantasy and people chasing non-existent crap. But as the fantasy is let go, money is reasserting itself. It will reassert itself fully. If you want to hear about the permanence of gold, that it cannot be replaced by any other money.
A 40% drawdown doesn't kill an asset, but it does expose narrative cracks. Rafi Farber emphasizes that Bitcoin fell over 40% from its peak, despite record institutional access and friendlier Washington rhetoric. That contradiction matters. When policy support and Wall Street adoption fail to stabilize price, the debate shifts from growth to purpose. Historically, Bitcoin has survived multiple 50% plus declines, yet competition from gold as a hedge and stablecoins in payments changes the framing. Investors should separate volatility from viability and reassess allocation size accordingly. As Rafi Farber suggests, the deeper issue isn't whether Bitcoin bounces, it's whether its role in portfolios is permanently evolving.